morning, everyone. Welcome back to the Wilson Weekly with Dr. Andrew Wilson, Chief Economist of My Housing Market, and myself, obviously, Graeme Holm. How are you, Doc? Good morning.
I'm really good, Graeme. We are well and truly into spring now, are we not? Second week of October. Yeah, well and truly sprung. It's interesting, of course, that we're now in that mid part of the spring selling season. The spring selling season is defined basically in three parts. The first part runs us up to those long weekend holidays that we had 2 weekends ago. And, of course, the break for the football grand finals. And then we move into the mid part of the spring selling season. And that leads us from now until the Melbourne Cup, which is the first weekend in November, holiday down in Melbourne. But that typically punctuates the mid part of the spring selling season, and then we run our way to the end of the year in the third part of the spring selling season, where typically we see higher numbers of listings. And, of course, depending on market dynamics, sellers are a little bit more motivated to sell because they want to get the deal done by the end of the year, but also buyers are also out there thinking, well, it might be a good time to buy, given a bit more pressure on sellers. But markets are still performing well for sellers, Graeme. We had some big numbers last weekend on the return from the previous weekend's break. So big numbers of auctions. Clearance rates were reasonably steady, a little bit down in Sydney, but we do see always a slight lag after we do have a break in the market. But the next couple of weekends will tell us where we're heading. It's a bit of an even match between buyers and sellers in the mid part of the season, the spring selling season. Of course, it depends on market dynamics, etc. And they certainly have been in favour of sellers for most of this year. And hasn't it changed this year, Graeme? Just looking back a year, we were really in the depths of the negativity in terms of what the market was telling us, the market, whatever that is, was telling us about the prospect for house prices. It's really once again been the complete opposite. Interesting today, Graeme, we've spoken, when speaking of scaremongering, we've spoken at length about and this was happening last year as well, the prospects of this so-called cliff, having an impact on the housing market this year. And the cliff was the prospect that those that took those very low fixed loan rates a couple of years ago, and they were in the 1%, some of them, would have trouble when those fixed loan rates matured in 3 years' time, 2 or 3 years' time. Now, we're going to head into that territory this year, and there was a sense that, with higher interest rates now, that those that took the low rates would get into some trouble. And that may mean they'd have to sell, shock horror, and therefore we'd have some issues with the housing market. Well, we can now officially say the cliff, just another crazy media beat-up. And those that wanted some cheap headlines, they got it in the short term. But we've actually had now, I guess you'd say, the official debunking of the cliff from the RBA.
We had last week, Doc, we had some fuel on the bank bashing bonfire. And this week we've got the Cliff Debunking. So there you go. We're coming out with some crackers. But you're right, Doc. I think as recently as February through to about May, I've seen a gazillion mainstream media articles that were clickbait and were, look at this. It could be a 20% crash, but it might be 5 to 10, or we could be wrong in the other direction. I mean, we do have to, as a consumer, we have to start looking at the data. I mean, that's what you do here. You're applying very, very prompt, efficient, reliable data. It's real-time data. I think we do need to be very careful about the clickbait. We need to be very careful about what friends and family are talking about, which usually is the clickbait. It's really important people take a scientific approach to, should we buy a new home or should we sell our home, or when's the right time to invest stock? Because, you've seen it for a long, long time, and as have I, that sometimes we're very quick to act out of fear. We don't sort of act out of abundance, but typically, let's get a crash, we should sell. And then all of a sudden it didn't crash and there's no cliff. You've said we've officially debunked it. So what's sort of starting to officially debunk the mortgage cliff, Doc?
Well, look, we'll look at the latest home loan data, Graeme, and part of that will be what's happened with fixed term loans, not variable loans, and how that's travelling. Had eased a little bit over with the latest data. We've got to really question some of the ABS data coming through it, and I mean this, and I say this advisedly because it really is a little bit all over the shop. When we look at the home loan data today, we'll notice that we don't have first home buyer numbers anymore because the ABS have said, look, we can't provide that because we're not confident that the data is accurate on first home buyers. And they, along with APRA, have said, well, look, we've got to really work this data set, rework it, because we're not happy with what the results have been over the last 12 months. Now, that's a very significant call because, it's very important that we know what first home buyers are doing. And the official results from the ABS in terms of first home buyer lending have been a very good indicator of that part of the market. But now we don't have it at all. We just have the generalised owner-occupied lending data and investors. So, again, this is this issue with the ABS. Yes, it's coming out of COVID. We know there's been a lot of problems with seasonal adjustment because everything changed dramatically through COVID. But, it makes it very difficult, when we don't have an efficient long-term data set to, give us those insights that we need on the market, particularly for buyer types. But as I said, we've got plenty of others. And you mentioned, Graeme, data insights that we provide, not just a single data set that give us variety and also sort of correlate what we're thinking about what's happening in the marketplace. So we've got a fair bit of data today, Graeme. So perhaps we should think about getting started, mate.
Yeah, let's rip in. That's what everyone's here for.
And the big
besides
picture is...
Besides a bit of bank bashing and a bit of media mayhem, they do like a little bit of data.
Yeah, look, that's right, Graeme. I think that, just speaking about what we do have, and we're probably used to it now because it's been going on for a number of years, this hysterical response to the prospects of the housing market and house prices and unit prices. It can be a positive if you realise and listen to, if you're making a property decision and you listen to, those that are providing rich data sets and commentary that supports that, as well as, a correlated sort of, not just one set, but a number of sets to position yourself, you can actually do well in that environment because unfortunately, those that do listen and make decisions based on these really outrageous predictions, unfortunately, get their fingers burnt, and that's the opportunity for those that are, confident in our marketplace, and we should be confident in our marketplace. Graeme, I did a little. We've when we've looked at house price forecasting, we won't do that today. We've seen that historical model when we've spoken about forecasting, and the first thing the forecasters should do is see, well, what's happened in the past? What's the history of house prices? And when we go back, we've seen that annual price model that we use back to 1987, which of course is decades and decades ago. Were you born then, Graeme?
Yes, I was. Just.
Yeah. So we are going back in time. But when we go back there...
You've made me feel old now, Doc.
Well, I'll swap you any time you like, Graeme. But anyway, that's another story. But we've only seen 4 years since 1987 where we've had, and this is the national house price measuring December quarter to December quarter, where we've actually seen prices lower over the year. Just 4 years. And the worst was 5.5%, and that was in 2018. But when we look at the top end, so that's 4 out of nearly 40 years or 30 years of data, and you could certainly call that the historical, measure, the modern era. Then when we average it out, Graeme, over that period of time, which I said is nearly 40 years, the average increase has been 6.7% over each year So the average increase in house prices, national house prices, over that period of 36 years has been 6.7% growth in the national house price. So that's the average over that period. So, you could always start with just the average if you were forecasting, you know what I mean? And that might be a good place to start. Anyway, I digress. But as I said, I think it's, taking advantage of that fear is what savvy, property investors do. Those that are, not just maybe buying for investment, but also for their own, their own dwellings. But let's get on with the story today. We could go on forever with this, but I think that was some interesting sidelines in terms of just how resilient and robust our housing markets are. So what we have today, Graeme, is the latest rent report, which is for September. So hot off the press, the latest rent report. Now, if we go back a month, remember we discussed the August results, and these are the September results. The August results, we saw a very sharp tightening in our rental markets, which are already at record low levels in terms of the number of available properties. So we saw a sharp tightening, and we discussed that perhaps one of the reasons for that was it was the start, or that coincided with the start of the second half of the tertiary education year. We know that there's been an absolute flood of international students coming into Australia post-lockdown, and of course that's continuing. The pressure on rentals, from international students, particularly for units, is, should I say, extreme. In an environment where we already have far too much demand for the available supply. But the big difference we have now, Graeme, with all these international students coming into Australia, is that we're not seeing the outflow because they didn't come in during COVID. So normally we get the inflow, but we're getting the outflow as those that have graduated, finished their visas, right? They're temporary. They've left, gone back home with their qualifications. Some stay, but, so you're not seeing that balance between those coming in and those finishing off because nobody came in during COVID, right? So that means even more demand because we're not seeing students leaving their rental properties to go back home. We're just seeing them coming in. So it's just another factor, of just pushing demand way ahead of supply, amongst all the other factors that we have, particularly under building. So that was the August story, Graeme.
Yep.
But I guess predictably, we've seen a bounce back in terms of higher vacancy rates and a little bit of a better position in terms of availability of rental property. So, that's good news. But this is the other problem, Graeme, is that because numbers are so low in terms of available rental properties, we see a movement in the measurement because they're so low. So it doesn't take a lot for it to either fall or rise because there's just a handful of properties really in most capitals available for rent. And that's what we saw over September, was following the rush we had in August for rental properties, an easing, but it would have been, in terms of the real numbers, not significant. But because numbers are so low, it's shown an impact on the results. So rental markets eased generally over September following that sharp tightening over August that likely reflected surging demand from high levels of international students commencing the second half of the academic year. Low vacancy rates and, of course, rising rents are set to remain a feature of most capital city markets for the foreseeable future, Graeme, despite that myriad of government initiatives designed to increase rental stock. So I think we've seen the surge in plans to try to cater for this. Now it's just a matter of, from governments, these policies, but now it's just a matter of waiting and seeing if they will work. And I think that's the point now, that everyone will just sit back and accept this as just being what it is, and that nothing's really going to change in the shorter term. And really the only down impact on our rental markets would be, and I hope it doesn't occur, would be a shakeout in the economy. But the economy is absolutely red hot at the moment. And a shakeout in the economy would motivate, renters to stay put with mum and dad or stay put where they were because of fear over job security, etc. So let's have a look at the data, the real numbers here. And we can see that we did see a general rising of vacancy rates over the month of September, Graeme, compared to August. But look how low those vacancy rates are, mate. Look, 0.7% Sydney, 0.8%. This is just crazy stuff. Perth has the highest vacancy rate for houses, and it's 1.2% now, which is very, very tight. So we're saying, it basically went up everywhere, the vacancy rates, but they're just so low now. It's here for the longer term, I believe. We look at the rents there. We saw Sydney rents stable at $750 a week. A little bit of easing of Melbourne rents at $575. There's still that nearly $200 gap, Graeme, between Melbourne house rents and Sydney house rents. And Hobart's now, which has been heading south in its housing market activity for the last few months, it's now the most affordable of the capital cities for house rents, down to $535 a week. But when we look at the, and you can see, look, we had a big rise in Brisbane there, 3% increase over the month. Brisbane rents, Graeme, up to $600 a week. So Brisbane's broken clear of Melbourne in terms of its rent differentials, house rent differentials. But look at the annual increases, Graeme. Still, we're well clear of the lockdown effect on rental markets, but Sydney's still up 15.4%, its house rent over the year. Melbourne, although it eased over September, is leading the charge over the past year, up by 17.3%. Brisbane and Adelaide up by just under 10%. And Perth, strong results similar to Sydney at 15.4%. So the major capitals are all charging ahead with house rents, Graeme, and we shouldn't be surprised at that given how low those vacancy rates are. So really, even though there was more choices for tenants over September, vacancy rates remain very, very low, and there remains, at the very least, no sign of an easing in rents in most capital cities over the month.
It's interesting there, Doc, that you've got Melbourne, Adelaide and Hobart are the only ones under the $600 a week mark. Yeah. Melbourne getting pretty close, $575.
Yeah.
Adelaide $560 and Hobart $535, but everything else well over $600 a week. I mean, it's interesting times. It's tough if you're a tenant, right? Look, it's tough if you're an owner with interest rates and bills, but it's bloody tough if you're a tenant as well. It's tough both ways.
Well, that $750 is a horror story for Sydney house renters, Graeme. There's not a lot of difference between Sydney incomes generally and those of the other major capitals. And yet, they're paying nearly $200 a week more for a house rent in Sydney than compared to Melbourne. And it's $150 a week more, than Brisbane for house rents, So it's a very tough ask. And that's why, we've seen that surge in unit rents. And I think when we look at unit rents, this is really a tough story, Graeme, even though unit rents generally were flat over the month in most capitals. Look at the Sydney result, up to $750 over the month. The median rent in Sydney for a unit is now the same as for a house, up by 4.2% over the month. And that was always coming. We had some relief over the last couple of months. It's back to its record high now, Sydney, $750. And similar to houses, we saw vacancy rates rise. But again, we have to emphasise it's coming from very low numbers. So a small change can mean a change in that vacancy rate. But numbers are very small in terms of available properties for rent at the moment for units, as they are for houses. And Sydney well ahead of, again, $200 a week higher than Melbourne, and well ahead of Brisbane as well for unit rents. A bit more value there in Adelaide and Hobart, $450 a week for a unit. we've got to remember there's just a handful of apartments in both those capitals, Graeme. So they don't have the impact in terms of the volume in housing markets that Brisbane, Melbourne and Sydney do. Melbourne down.
Sorry, Doc, I'm on houses still, not units. Sorry, it might have frozen.
Oh, sorry. I'm looking at another slide there.
There you go. Yep,
there we go. Brilliant. Sorry about that. Yes. So we start all over again. Well, just snapshot there. Sydney up 4.2%. Record level of units again. It was always going to happen, $750 a week, still $200 a week higher than Melbourne, as we saw with house rents.
Wow.
Brisbane steady. Just under $600 a week for units, which is similar, of course. Which is similar to the $600 for a house rent in Brisbane. And Adelaide and Hobart offer the most affordable options for tenants in units, but we've got to understand there's just a handful of units in those particular capital city markets. But I think that it's, what's instructive is if we look at the growth over the past year, Graeme, in unit rents, Sydney up by 31% over the past year. For unit rents. Of course, there's still an overhang there from what happened during COVID, where virtually there was, no demand for units, particularly inner city units from students and travellers. Melbourne up 25% over the year, and Brisbane up 21%, Perth up 22%. So big numbers there. Again, Hobart the exception with rent, with its markets had been easing.
Doc, do you ever recall a time historically, since you've completed all of your studies and built your career, do you ever recall a time where unit rents have increased 31 or 25%? And if so,
no,
when
right.
and why?
No, well, we can't. I mean, this is what reflects, or this reflects what a completely unusual event COVID was. That the market stopped basically for unit rentals. During COVID, because we didn't have the drive from international students. We had the Airbnbs moving back into the permanent market because the shut borders meant there was no interstate or international travel to take advantage of Airbnb. So rentals just collapsed. And of course, we did have the peak of the previous building boom in terms of units coming into the markets in Melbourne and Sydney, those inner city markets. So it was a perfect storm of sort of negativity. So it was always going to bounce back. But now it's being enhanced by, the reopening of borders, undersupply, high house rents are pushing a lot into the what was the more affordable unit market. But unit rents are now tracking house rents in most capitals, Graeme.
Wow.
And even that Melbourne vacancy rate, which is, now at the highest of the major capitals at 1.7%, it was Melbourne's vacancy rate was 6 and 7% at its peak, during COVID, and it's still got some catch up happening there, which I think we'll see some upside to Melbourne rents continuing. Although there's some issues with the Melbourne economy at the moment, but no doubt that this is an unheralded and certainly unprecedented period in our rental markets. It's not just that we're seeing this these low vacancy rates and rental surges. It's the consistency amongst most capitals, Graeme, that we're seeing. It's not just one market outperforming another or underperforming another market. It's the consistency really across the board, and what that's showing us is that that there's a systemic problem in our market. We're sort of rebalancing after the COVID event, but now, we're just here, having run out of rental properties. So how do you get more rental properties? Well, you just build more houses. And we can't do that. And we're going to look at the latest building approval data next, Graeme. But again, there's really no relief in sight for that. And all the good wishes of the government aren't going to change this, because they can't really impact the housing market in terms of new build at the level that we need, which is hundreds of thousands of houses. They might be able to add tens of thousands, but not the hundreds of thousands that we need. So basically, the role of governments going forward now will be just to look after those, and that's going to be increasing that really can't find accommodation at all. They just can't afford it, right? And that's what governments are going to have to be looking to do, because, they just can't impact the market to the point where it'll become more balanced between supply and demand, and I think, that we're going to start to see some policies, even though I said before, maybe there's just a wait and see from now on. But I think governments will have to start thinking about incentivising private investors, which have been they've been kicked around for some time now. And I think the realisation is, well, maybe we should have given them a better go. We wouldn't be in this mess. But so I think that we may start to see some incentives to private sector investors to get them into the marketplace. I know there's, measures happening now to restrict Airbnb, to incentivise them to move into the permanent marketplace. But, this is just realisation that the problem is we don't have enough private sector investors. Yeah. And that's where the demand is really the supply is going to have to come from to be able to match what will be increasing demand.
Mm. All right, not a good story for rent still, unfortunately, if you're a tenant.
Well,
what
not
about
good
home
for
building,
tenant,
Doc?
But just on that, Graeme, you said it's not good for the tenant, but in what was a period of significant period of higher interest rates, it's good news for the landlord. At least there's some options, and also, all the silly talk about rent freezes is now died a death, which it was always going to. Thankfully, has. So that's one less worry again for investors that that they can match their outgoings with their income in a very tight rental market. So we saw home building approvals rise, Graeme. Yeah, 3 cheers, maybe. Oh, is this the change? Is this the change? Well, don't get your hopes up too high, folks, unfortunately. So home building approvals were up by 7% over August. But of course, Graeme, that followed a 7.4% July fall. So basically, over 2 months, we went nowhere. And this is what's happening with this data that we're getting. Now, this is supposed to be seasonal adjusted data. Well, it is seasonally adjusted data. So it should take out that volatility. But in building approvals, the volatility is really about unit development, right? Because units can be quite a volatile data set because, you can get a very big unit development coming through in a month, and that'll push the approvals up, and then you go back to sort of just a normal level. So that can bounce around according to particular developments that do come through. And that's what we saw. We saw units up 9.4% over the month, houses up 5.8%. But it really did just balance out what we saw the previous month. So it was a net zero gain over 2 months. And of course, Victoria, after falling sharply the previous month, was up sharply by 22% in terms of building approvals for homes. So that came from a big, large development coming through, unit development coming through in Melbourne. So, but annual growth certainly remains chronically depressed, Graeme. So, as I said, even though it was a big result over August, it just basically counted what was a fall over July. So this is the story of building, of course, and you can see there when we look at the trend, it continues to fall. At best, perhaps flattening recently, the trend, but we don't need a flat trend from a low base. We need a rising trend. And we know next week we're going to look at house building costs, Graeme, the latest house building costs. And we know that that's just another barrier, for higher levels of home building. And it's really not falling away, house building costs, at the level where, builders are starting to think about making profits again. But we'll talk about that next week. So the trend is certainly continuing to fall. And we can see there the rise there over the month, houses and units were up. But we can see when we look at the result over the year and over the full year, we can see that it's all still very much downwards when we compare it to what was happening a year ago. And of course, that longer term trend So no real relief there. And this is the big picture, Graeme. This is National Capital City home building approvals trend. So this takes the monthly data, converts it into an annual result, and then looks at the trend going back. And you can see that we're still 35% lower at the moment since our 2016 peak. That's a lot of houses, despite that blip that we had during the COVID stimulus period. We're now, continuing to fall. You can see that's still trending downwards on the long-term trend, and we're well below where we were at our peak in 2016.
Doc, it's just we don't have enough people, we don't have enough homes, we don't have enough trade. It's like, how can we have so much demand that just outstrips supply and labor? It's bizarre. It's like we've been so suppressed during this COVID era that everyone wants everything all of a sudden, and just the world can't keep up. We're consuming ourselves.
Well, look, US is in the same boat, Graeme. A number of the big cities in the US, are in the same boat. They've underbuilt, and it's the same problem, And COVID as the volatility of COVID has accentuated this issue. So we sort of got away with it during lockdown. It was starting to become apparent because we still had the surge from that big development period in 2016-17. But, now it's come home to roost that we just haven't been building enough houses. All those things we've been doing really have been taking our eye off the ball. All the roadblocks that we put in front of home building, have got us to this position where we've basically run out of houses. And, green tape, red tape, not in my backyard, planning restrictions. We all thought, we can get away with this. We can be circumspect about how we build. In other words, we can put barriers here and barriers there. But at the end of the day, what's happened, if those policymakers who are responsible for this need to have the finger pointed at them for what is, a collapse in livability in terms of finding affordable accommodation. And this is a longer term problem now. And heaven forbid we sort of get to the stage where a number of those big US cities have found themselves, and that's people having to live on the streets permanently in high numbers, But as I said, at a certain level, you can afford to be generous in terms of particular views on what is appropriate housing. But if you can't house your populace over the medium to longer term, you will find that this is a significant barrier to living, and it's something that I would suggest that the populace is not going to put up with. So as I said, it's one thing to be generous with the models of housing that we think are appropriate, but when you've created chronic shortages of accommodation and housing, the implications are really severe. In terms of, the social environment, Graeme. I don't want to sound too negative, but, you've got to understand that. And we can only look at the US to see what that problem is. And their issues are the same as what we have. The same issues are driving that problem. And it's like, once you get to a certain point, you really can't unscramble that egg. You know what I mean, Graeme? It's sort of a done deal. So some better news on building approvals, but we need to see it significantly higher going forward, and let's keep our fingers crossed, and let's hope that's not all we can do just keep our fingers crossed to improve the outcome. So we also had the latest home loan data out, Graeme. Home loans were up. Again, we have to take this data with a grain of salt because, as you can see, it's been bouncing around from month to month. We know there's been a significant increase in buyer activity when we look at the housing market. And so lending activity should be following that, but it's been a little bit up and down. The ABS have put their hands up to admit that there's problems with their measurements. So, okay, for what it's worth, that was the latest data. Investors and owner-occupiers were both up over the month, and but still well below where they were a year ago, Graeme, and well below their previous peaks for lending. We spoke about refinancing. Refinancing fell a little bit over August compared to the previous month. So again, that's probably a sign that the refinancing surge has now eased. And the proportion also fell away when we compare refinancing to new owner-occupied loans for established properties. So just a sign there that, the issues over refinancing and fixed loan rates, that would take those low fixed loan rates, we spoke about that before, is now a thing of the past, and that the actual market is now showing that there's less appetite for those refinancing products because most people have locked themselves into new loans. So I mentioned, Graeme, that this is the debunk. So shall we talk about the debunk?
Well, let's see if we're falling off the cliff or we're just heading down the road.
Well, the latest RBA financial stability report certainly has debunked the cliff, Graeme. So this is sort of the official stance on, what happened or has happened. So despite interest rates going up significantly, most households are handling it well without causing problems for the economy. The bank has said that their liaison program has reported that borrowers have been more resilient than expected. Do you notice that? More resilient than expected. So that's just I've underlined that one. That's a bit like, house prices have been more resilient than expected, right?
Is that a fancy way, Doc? Is that a fancy way of saying we got it wrong? More resilient than expected.
Yes, it is, great. Let's just hope that it's, and maybe, let's just hope it's not inflation has proved to be more resilient than expected, but that's another story. So, Reserve Bank, hello. So borrowers have been more resilient than expected. This is my underlining, in their ability to service their debt given the sharp rise in interest rates. So while non-performing loans have increased slightly in recent quarters, they remain, at near decade low levels. And the main risk, of course, would be a severe rise in unemployment, which we've always said. So, I should have underlined bank non-performing loans remain near decade lows. Okay? So currently around 5% of variable rate owner-occupiers have essential expenses and mortgage costs exceeding income. So only 5% of those are in a little bit of trouble, but about 70% of those borrowers have sufficient savings in their offset and redraw accounts to finance their cash shortfalls for at least 6 months. So,
3% of those people are in trouble.
Have essential expenses and mortgage costs exceeding income, right?
But 70% of those have plenty of savings, and obviously are making a decision to not generate extra income or not return to work for maternity leave or blah, blah.
Yeah, and that means what, 1%? So we're really talking 1% of those are unable to draw on that. And yet we have, and that is our normal non-performing loan environment, and yet non-performing loans.
I got it backwards. 70% have sufficient. I was going the other way, saying only 30%, 70. So literally, you're talking
1%.
Only
1%.
It is decade lows, and they've got buffers. Wow.
Yeah. And that's the point, we're at decade lows in terms of non-performing loans. So, I wonder if there'll be any particular media event around that news from the RBA. So we move on. We finally at least got some satisfaction for those who might be still silly enough to be talking about the cliff, Graeme. So we can inform people out there that the cliff didn't happen, and of course we have been saying it wouldn't happen for a number of months, if not longer. But once again, let's hope people didn't make buying and selling decisions based on that scare campaign around the cliff. So we'll finish off as usual, Graeme, with our auction market report. So it was the mid-spring auction market. Markets returned from the previous weekend's holiday distractions. We've sort of spoken about that. We had a predictable surge in listings, but results weren't too bad. And usually following a holiday break, the sellers come in and the buyers are some of them at least still have their head in holiday mode, if you know what I mean. significantly higher listings, of course, act to reduce clearance rates, as well as that still distracted perhaps buyer market. But of course, we did have interest rates on hold again, which is becoming a bit of a ho-hum story, I would suggest, but certainly adds to a bit more positivity, or to positivity, which is clearly there in our auction markets. So when we look at the actual results, Graeme, big number again of Sydney auctions, 800 auctions, well up on the previous weekend, 70% clearance rate, a little bit down on its previous highs, Graeme. So we'll wait and see how Sydney performs over the next few weekends. But we've seen a little bit of up and down from Sydney. We are moving into the middle part of the market. I think we've got to emphasise, Graeme, that there's been a real surge in housing market activity almost across the board this year. And a lot of those buyers have satisfied themselves. A lot of the pent-up demand has expired. Of course, prices are nearly 10% higher in Sydney than where they were at the beginning of the year. So that starts to push buyers out of the market, and still having a 70% clearance rate, which means that basically you've got a 7 out of 10 chance of selling your property under the hammer last weekend following a holiday break. I think is still positive news for sellers in Sydney, and still ahead of where we were a year ago in that Sydney market. But you can see the difference in listing numbers. Nearly 200 more listings in Sydney compared to the same weekend last year. And Melbourne screamed back into the market, nearly 1,000.
Yeah, wow.
Yeah, big number in Melbourne. Good signs here in Melbourne, Graeme. 124, of course, which basically meant just a handful of auctions in Melbourne the previous weekend. Distractions from the AFL Grand Final, of course, and their long weekend. They have the Friday holiday, Grand Final holiday. But still a 70% clearance rate, Graeme, which is just about where Melbourne's been tracking for a while now, around that 70% mark. It is a little lower than its peaks. It did get up to the 75s at one stage there in July and August. So still a little lower, but once again, similar to Sydney, a good result, a reasonably good result there for most sellers. But that number of auctions, Graeme, is the highest this year so far in Melbourne for a weekend. So it was a year high, this year so far high for auctions. So again, those properties were mainly sold. And, I think that, again, that's a good result for Melbourne. Once again, well ahead of the listings of a year ago, with clearance rates also higher. Brisbane higher numbers, similar clearance rate. Adelaide back into the 80% with a big surge in listings following their break the previous weekend. And Canberra just starting to move a little bit sideways at the moment, Graeme. But I think good results there, Sydney, Melbourne, Brisbane and Adelaide, and perhaps Canberra, with big numbers coming in, paid the price with a lower clearance rate. You can see how Sydney clearance rates trend has just started to ease over the mid part of spring, but it's been such a strong market. We nearly got to 80% at one stage there as a monthly result. And we know that's a boom time result, Graeme, and really was a very, very strong late autumn market, and has consolidated since then. And it'll be interesting to see how the Sydney market tracks over the next few weekends until we get to the next break in the market, which is around that Melbourne Cup holiday period. Melbourne just holding up a little bit at the moment compared to September's results. Of course, this is just the October results are just last weekend. But similar to Sydney, Melbourne's come off its highs. And this is how housing markets work, Graeme. They bounce back after a period of decline. They make up for those that sat on their hands, that pent-up demand. It gets released, and then we start to consolidate and move into more of a balanced market, which is a really good thing. And I think that's where we're headed now, Graeme. But what will be undoubtedly a strong result for house prices in most capital cities for this year, particularly compared to last year. Brisbane just holding up at the moment compared to the September, but again, similar to Sydney and Melbourne, down from its highs over late autumn. Adelaide just keeps on keeping on, another 80% plus result, nearly 90% result there in Adelaide. And as we mentioned, Canberra has just slid backwards a little bit over recent months. And we've noticed that also in some of its results for the rental market and its prices as well. So we know that auction clearance rates are a great forward indicator of what's happening generally in our housing market. And it's something that buyers and sellers and then those that are interested generally in the market should take account of. And they can get that for free every Saturday night, the Capital City results on my LinkedIn account. And Sunday mornings we have the National Auction Market Report, which includes regional breakdowns for Sydney and Melbourne. So get a hold of that. So we're just finishing off with our latest ad for the app, Graeme. This is our ad app. Does that make sense? So we have a great little app available here for those that are interested in real-time insights into what's happening in your housing market at the suburb level, Graeme. So our app provides on every suburb in Australia that has data, you can determine, or it will tell you, what the median asking price and rent is for that suburb currently. Also the high price, high rent, low price, low rent. It will also tell you the number of listings or the number of properties for rent in that particular suburb. And you can also filter it, Graeme, for a house, a unit, a townhouse. And you can also filter it, mate, for the number of bedrooms. So you can look at a 2-bedroom house, and this is for all the suburbs in Australia. So get a hold of that one by taking a snap of that QR code. But you'll see that there's a link there, and when you click on the link to the app, you will see you have to put in a password. Well, the password is organised by the Infinity Group, so you have to get through Infinity to get a hold of that password, to get a hold of that great little app, which you can carry around with you, and it'll tell you exactly what's happening in the housing market on a suburb basis in real time. So thanks to the Infinity Group for managing that, and thanks to My Housing Market for producing it. So I'm excited, Graeme.
Absolutely, Doc. And for those of you who are in our community, you talk to your relationship manager, and it's in our private community group that the public can't see. The password is pinned at the top of the page, so you can go and use Doc's app. So there you go.
Excellent stuff. All great. I'm excited.
And we'll be seeing you live on Friday night, Doc, for a big live education session with a couple of hundred of our community, and it's going to be fun.
Excellent. It's going to be fun, and I hope there's not too much champagne flowing, but then again, maybe I don't. But
as long as you get to drink it, Doc, but you don't have to pay the bill, you'll be fine. So there you go.
That's true. Yeah, that's true. So next week we're going to look at our regional housing markets. Let's look at some prices and rents in our major regional markets. And as I mentioned, Graeme, we'll also look at house building costs, and let's see how the second week back from holidays, how our auction markets perform. So lots to talk about next week. So let's get excited.
Forward to it.
All right, so that's it from me. Yeah.
So we'd appreciate it. We've had the bank bonfire. We've had the debunking of the Cliff. Stay tuned for next week, ladies and gentlemen. We'll see what Doc and I come up with. Thanks, Doc.
Good on you, Graeme. Thank you.
Thank you.